There are certain limitations related to the positive relationship between GDP and welfare. Or we can say that there are certain limitations related to GDP as an index of social welfare. One of the limitations is negative externality. What is meant by externality? In economics, an externality or external cost is an indirect cost or benefit to an uninvolved third party. That is, external cost or benefit to someone other than that person who is involved in that transaction. When the activities of a person or organization result in benefits to others with no payment received for the benefit is called positive externality. When the activities of a person or organization result in harm to others with no payment made for the harm done is called negative externality. Externalities arise due to interdependence of economic units. It is a cost or benefit imposed by the production and consumption activities on those who are not involved in these activities. Example, for positive externality, a public park developed by the local government. It is for the welfare of the people of that locality. But if it is used by antisocial elements for antisocial activities, then it will become negative externality. Then another example of negative externality is noise pollution created by loudspeakers, the air pollution caused by the industries. So externalities refer to good and bad impact of an economic activity without paying the price or penalty for that. The concept of green GNP is developed to reduce this limitation. Next is planned and unplanned inventory or planned and unplanned stock of a firm. Inventories or stock means unsold finished goods and semi-finished goods with a firm. What is meant by planned inventory or planned accumulation of inventory or stock? In case of an expected fall in sales in a particular year, the firm will have unsold stock of goods which has been already anticipated. So, there will be planned accumulation or increase of stock, which is called planned accumulation of inventories. That is, in case of expected fall in sales, the firm's unsold finished goods will increase. It is planned by the firm. Unplanned means it happens due to unexpected fall in sales. So the firm will have unsold goods which is not anticipated. So this is unplanned accumulation or increase in inventory. So we can explain this with an example. If a firm has opening stock or opening inventory in a year of 100 units, but it wants to increase, accumulate its inventory or stock from 100 to 200 units. That is the plan of the firm. And it expects that the sales to be 1000 units. So the firm will produce 1100 units because its opening stock is 100 units. It wants to increase it to 200 units, 100 more. Expected sale is 1000. So naturally it will produce 1100 units. And at the end of the year, it is found that the actual sales is also as expected. That is 1000 units. So the firm's stock will increase as it expected from 100 to 200. How can we calculate it? The closing stock of the firm in that year will be final stock, final inventory or closing stock is equal to opening stock of that year, that is 100 units, plus production. How much is the production? 1100 units, minus from that, from the stock and from the production, 1000 units is sold. So the stock is 200 units. So everything goes as planned. In this case, stock accumulation or inventory accumulation, accumulation means increase, is equal to the expected accumulation. Therefore, it is a planned inventory accumulation. In case of planned decumulation, decumulation is decrease, that is planned by the firm. The firm wants to reduce its stock. So it will be producing only 950 units instead of 1100 units. And sales will be, it expects that it will be 1000 units. In that case, if sales is equal to 1000 units, production is equal to 950 units, opening stock is 100 units, then the closing stock will be, closing stock for that year will be final stock, final inventory, or closing stock, closing inventory is equal to opening stock plus production minus sales. What is opening stock? 100. Production only 950 units minus sales as it expected 1000 units. So 100 plus 950 minus 1000, it will be, instead of 200 units, it will be only 50 units. This is planned decrease, planned decumulation. Unplanned inventory refers to change in stock, change in inventory, which has incurred unexpectedly. It is not anticipated. In a situation of unplanned inventory accumulation due to unexpected fall in sales, the firm will have unsold goods which has not been anticipated. For example, if a firm has opening stock of 100 units, it wants to raise its stock from 100 to 200 units and expects sales to be 1000 units. It will produce 1100 units. But at the end of the year, it is found that the actual sales were 800 units only. Then what will be the closing stock? It is an unexpected stock, that is opening stock plus production minus sales, 100 plus 1100 minus 800, 400 units. So its expected stock was 200 units. Instead of that, due to unexpected fall in sales to 800 units, the accumulated, that is unplanned, it is unplanned accumulation of stock, it becomes 400 units. So it is an example of unexpected inventory increase or accumulation. But the opposite situation is, if the sales goes up than expected, instead of 1000 units, 1050 units is sold, then the stock for next year will be only 50 units. So instead of 800 units, it becomes 1050 units. The expected sale is 1000 units only, and sales goes beyond that, 1050 units. This is unplanned decumulation, decrease of stock. Regarding unplanned accumulation, increase in stock, the whole world has experienced it during COVID-19. Almost all the firms in the world experienced unplanned increase in stock. There is a direct relation between the value added method of measuring national income and change in stock. Gross value added or GDP by a firm is equal to sales plus change in stock minus intermediate consumption. It implies that as inventory or stock increases, the value added by a firm will also increase. Thus, there is a positive relation between value added and the change in stock. Change in stock is equal to closing stock minus opening stock. Next, please watch my videos for the calculation of national income by income method, expenditure method, and value added or product method. Almost all the problems will be covered through these videos. Thank you.